Ladies and gentlemen, please welcome to the stage Bloomberg's Michael McKee.
Thank you all. Thank you, Charlie. Charlie said you should take your seats, and you all did. I'm very proud of you. Very good job. I am Michael McKee from Bloomberg Television, and I'm delighted on behalf of all my Bloomberg colleagues here to welcome you to the future of investing, where global growth is driving transformation. And from what we know now, we hope that's not in a self-driving car. We'd also like to offer special thanks to our sponsor for the evening, Invesco QQQ. Hope you've all had a chance to network with your colleagues, or as we call it, grab a drink in the back. Feel free to take notes tonight. Everything we say here is on the record. And we're going to look at global growth through the lens of transformation, number of areas in which global growth is being transformed these days, and global opportunities for you all. Policy and economics, technology, of course, a huge driver, the impact on business investment of both technology and fiscal policy in the United States, where markets are in the growth cycle. We love to use the baseball image of what inning we're in, and we'll talk about that. And then, of course, you wrap it all up with what strategies are best to take advantage of the world these days as we find it. We have a great lineup of notable executives, economists, investment professionals here to help answer where the risks and opportunities are. I want to mention, find one opportunity for us here. Is anybody here from Canada or Mexico? We're going to charge you an extra 25%. President said we could do that. As one of our panelists told me this week, it is getting harder and harder to make money these days, even though we're seeing tremendous growth in the United States, which seems a little odd. I mean, are we past the peak of the growth cycle? Are we getting to the point where returns are going to continue to be compressed, even though we see good things happening out there? Are we seeing the end of synchronized global growth? You know, the Atlanta GDP Now tracker, the Atlanta Fed's GDP tracker, shows that if the quarter were to end today, the second quarter would be 3.5% annualized growth, which would be the strongest since 2014. So why are we seeing markets somewhat becalmed these days? Employment strong, unemployment at record lows, but companies aren't ramping up expansion plans, even though they're getting better tax treatment these days. And productivity still remains low. Unemployment is falling in Europe as well. Companies there are not expanding as well, and investment stagnant. Productivity in Europe also quite low. Growth is actually slowing there from the latest statistics that we have. Strong, but still starting to slow. And even the same thing is happening in China, which has been the engine of global growth in the Pacific for quite some time. They do count things a little bit differently. Xi Jinping calls up Li Hua and says, what is GDP? And Li says, what do you want it to be? That's the way they work. But even with the numbers that they do publish, we see them slowing. So where do we go from here? A reminder, as I said, everything here is on the record. Please feel free to tweet your comments and observations and photos. Use the hashtag #TheFutureOf. And you can follow our Twitter feed via @Bloomberg Live, and also tweet @InvescoUS. We know everybody loves to tweet these days, so please feel free to do that. All right, enough from me at the moment. I'd like to bring on a special guest to the stage. Please join me in giving a warm welcome to John Frank. He is QQQ Equity Project Strategist for Invesco. And we'll give him a moment to get here. Thank you, John.
Thank you. Thank you very much. So good evening. It's a pleasure to be here tonight. And on behalf of Invesco QQQ, I would like to welcome you to this program, The Future of Investing, where global growth is driving transformation. Given that Invesco QQQ tracks the NASDAQ 100, which is the 100 largest stocks, non-financial stocks on the NASDAQ, many people assume it's a technology fund. In actuality, in 1985, NASDAQ created the NASDAQ 100 to be a large cap growth index. Well, they also created the less popular but also important NASDAQ Financials 100 as their large cap value index. And for us, I think a lot of times investors are surprised to learn that within Invesco QQQ, actually about 40% of the fund is non-technology. And for us at Invesco, we really view those underlying constituents as innovators disrupting their respective markets. For those who don't know, Invesco QQ is the 8th largest ETF and 2nd most traded ETF in the US. And if there was a Mount Rushmore for ETFs, we'd think that Invesco QQQ at nearly $66 billion and a track record dating back to 1999 would certainly be on it. So Amazon is the most used example of a non-technology company using technology to create competitive advantages. Tesla's another company that blurs the line between sectors. Is it a car company that implements cutting-edge technology, or is it a is it a tech company that makes cars? And for investors, does it really matter? You think about all companies, technology or non-technology, they really need to utilize technology, or they risk becoming vulnerable to their competition. And I think all companies, again, need to grow. Growth is important for the top and bottom lines for all these companies. And there's no doubt about it. You look across the NASDAQ 100, you see companies trying to grow into new businesses. Apple, for example, is trying to convert their over 1 billion devices to become credit cards so they can partake in the payment processing business. Google, among others, is developing self-driving cars. And Netflix and Amazon are competing annually for Oscars and Emmys. And we're also lucky to be joined tonight by a NASDAQ 100 and QQQ constituent, Mondelez International, to hear how they're trying to grow their business globally. Additionally, I think a big surprise when it comes to Invesco QQQ is how strong its long-term track record really has been. Morningstar awards it 5 stars across all time periods, and within the Lipper large cap growth universe, it's actually the top 1 percentile over 10 and 15 years as of the end of May. And we really look at that long-term performance as being due to the fact that you have these large innovators, large companies that continue to grow, that are innovative and do more than just pure technology. So when it comes to markets, there's much to learn and digest. And we, Invesco, are happy to be here tonight to be part of that learning process and hope you find tonight's agenda and program useful. So without further ado, thanks for coming and enjoy the program. Thank you.
Thank you, John. He gave us a hint about what's coming next. As we begin our program, we want to start with an examination of how a global business, in fact, one of the world's largest snack and consumer companies, is thinking about how growth is driven by innovation and how technology impacts that growth. And so for that, please welcome to the stage Bloomberg's Craig Giammona and a special guest.
All right, so we are joined here by the global head of e-commerce at Mondelez, which I like to think of as the maker of Oreos and other things like Triscuits and Ritz. So we were talking before, Jeff, and you made an analogy that I thought was pretty interesting. You said that thinking about a supply chain that was set up to service grocery stores, trucks and pallets of Oreos going to a Kroger or an Albertsons or something like that, versus what you're facing today with e-commerce. And you said it was the difference between a supply chain built with tanks versus a supply chain with motorcycles.
Yeah.
I wonder if you could sort of explain what you meant.
Sure. Yeah, we use that metaphor to quickly communicate the challenge that we have as a big global company who's seen our supply chain literally for the e-commerce business having to transform itself. So I think most of you know that e-com is the fastest growing channel for CPG. A lot of people think it'll drive 50% of all the growth over the next 5 years. So for a CPG company like Mondelez, that means we've got to build new capabilities. The big 3 areas for us are data analytics, supply chain, and really digital technology. So on the supply chain front, in simplistic terms, e-commerce retailers want smaller, more frequent shipments. So we have a supply chain full of tanks, I like to say, that service big grocery stores. We ship pallets. But in order to service the e-commerce business, we need something like motorcycles. We've got to get it there quickly. We've got to go more frequently. And it's been a real challenge for us. It's a challenge for all CPGs, but we're making great progress with this and literally reinventing our supply chain for e-com.
It really is amazing to me how fast it's growing. I mean, Mondelez is a $26 billion company, roughly. Your goal is to get to $1 billion in revenue e-commerce by 2020. It was up, I think, 35% in 2016, another 40% in 2017. So when something is changing that fast and there's that much growth, I guess, how do you sort of stay nimble and make sure that you're on top of all that?
That's a great question. So the business is very dynamic. It's growing really fast. If you want to grow as a CPG, you got to win in e-commerce. So it not only involves capability building, but developing really tight partnerships with our digital partners. So we have JBPs with Google, with Facebook, with Amazon. The ability to leverage data to really engage with consumers in new ways that we can do in digital media, and it also affects how the type of products that we bring to market. So we're faced with having to commercialize new product lines exclusively for e-commerce. That gives us some new opportunities as well, though. Opportunities to get into areas of the business that represent real incremental growth and incremental consumption for us. So we're looking at testing and developing new business models for e-commerce, as well as just servicing the needs of the common consumer who's just migrating online, right? And making sure that our full assortment is available on Walmart.com, on Amazon.com, and then looking for innovation opportunities to get into new consumption opportunities like gifting.
Right. One of the things you guys have been experimenting with in the last couple of years is sort of direct-to-consumer tests, which I think is a pretty big departure for CPG companies. Yep. Traditionally, you've sold through grocery stores. You've used Oreos to kind of connect with an online customer. Last Christmas, I think it was $19.99 for a tin. And the interesting thing to me, I guess, is that you decided to kind of handle some of those logistics yourself as a way of figuring out kind of what your capabilities were. What did you learn from the Oreo test during the holidays?
Yeah, direct-to-consumer is an interesting space for CPG. It gives us a place to do a lot of testing and learning. So we look at it like a sandbox. We can test new assortment in direct-to-consumer on a relatively small scale. We can do a lot of A/B testing in a direct-to-consumer environment that we can control. And with the Oreo test, we tested a variety of price points. And one of the big tests was, can we deliver this through our own supply chain and logistics network? So we learned a lot from that. We found out we actually could do it on a limited scale. And direct-to-consumer is a part of our core strategy. It's probably not where we're going to see the biggest part of our growth. You mentioned we're on track to deliver $1 billion by 2020. The direct-to-consumer part of that is maybe 10% or something. So we see it for special opportunities in the area of gifting and in the area of developing new assortments and bundles and testing and learning. So that was a very effective test. From there, we even launched something called the Oreo Cookie Club. So that's something where you can get packs of Oreo on subscription. So we did a lot of testing and learning with that too. So you'll continue to see us innovate and use direct-to-consumer as a great platform to test and learn and commercialize new assortment.
Right. I mean, I think the average person who's not a supply chain or logistics expert maybe doesn't appreciate the difference between pallets of Oreos to brick and mortar grocery store versus tins of Oreos where someone is ordering through a website that you set up and then you're shipping them out. I mean, how different is that?
It's night and day. It requires a totally different setup and a different set of capabilities. We are working with some people who are really good at that as well. So I don't know that we're really looking at taking on the entire fulfillment aspect of it, but there are parts of the direct-to-consumer supply chain that we think we can do ourselves. So we'll go at that selectively.
Another interesting piece of the story, I think, is how much bigger e-commerce has gotten outside of the U.S. You came from Kimberly-Clark. You sold a lot of diapers online. I mean, I think you said in countries like South Korea, it's almost all of the diapers are bought through e-commerce. Why do you think the U.S. has lagged as far as the percentage of sales that's moved online?
So it is really interesting to look at global trends like that. And what you see is different categories, reaching tipping points. And typically, you see a tipping point at about 5 to 7% penetration online. In the U.S., for CPG or for food, we're only at about 3% right now. A lot of this is driven by retail innovation, or in other markets like in France and in the UK, penetration of grocery online is closer to 10%. And they just started earlier, I think, in the game. I mean, you have all the macroeconomic factors in the U.S., of course, for it to get really big. And the rate of growth for us is fastest in the U.S. and in China. In Europe, some of those markets, like Germany, like France, like the UK, are a little more mature. They're already at that high penetration rate level, and it will come in the US. We see very strong growth rates. I think for food and beverage, the category is growing online at about 15 to 20%. For snack foods, it's a little higher than that. Wow. So we see very strong growth in the US. And you may have seen Walmart and Kroger now have finally really gotten in the game. They're investing big in click and collect locations. This is one of the fastest segments of our business growing. The other segment that's growing is home delivery through Instacart and Shipt. So you've got three big pillars in the US now: Amazon, Walmart, and Kroger driving click and collect, grocery pickup, and then home delivery. And so we're really happy about the way the market's developing. It's healthier to see it spread out a little bit, and I think we're going to see strong growth rates.
Yeah, it does seem like the world changed. About a year ago, Amazon announced that they're buying Whole Foods. I feel like that was a pretty big wake-up call for a lot of the traditional grocers that, in an industry that sort of had been insulated from e-commerce for a while in a way that electronics and apparel were not. Yeah. E-commerce has arrived in food. So it sounds like you don't think there's anything structural in the U.S. that will prevent this from getting to 10 and 15%.
A lot of it it gets to retail readiness. How willing are retailers to innovate and drive, if you will, adoption into the channel? But the number one driver of e-com is convenience. And so parents over-index dramatically. Consumers are strapped for time. And it's really not about price and value, which I think in the early days, e-com was more about getting a great price. That's kind of table stakes now. It's really about convenience. So you see things like Prime Now growing like crazy on Amazon. Consumer expectation now is for 1 to 2 day delivery for everything. And these different fulfillment models are really addressing different consumer needs to meet different shopping missions, if you will. So you see a lot of the growth coming from retail innovation, and now consumer adoption is coming on strong. We think in the U.S. for food, it'll get to 10% pretty quickly, probably by 2025 at least. So we see very high growth in the U.S.
So in terms of snack food, going back to Oreos, that's a product that sometimes you'll walk by it in the grocery store and say, there's the double stuff, I better grab that. How about creating that online? When this customer is just logging on, they're looking for something else, how do you sort of put Oreos in front of them and make sure that they remember that they like Oreos?
So that's a great question too. Driving impulse online is a challenge. If you look at traditional impulse categories like chocolate or candy, they tend to under-index online. So I think we need a new model for driving impulse online. It's not the same analog model where you've got end caps and people walking through the store and shelves. But where we're finding success is by leveraging data, looking at three different kind of use cases. One is a reminder where we know that you've bought Oreo before. You're shopping online, but you don't have it in your basket. So we send you a reminder. Don't forget the Oreos. The other is in the realm of discovery. So a lot of consumers like to discover, and explore new brands. So that's another way to drive impulse. But it's really about leveraging retail data and tailoring the proposition to the specific consumer behavior. And that's something that we're real excited about. We call it personalization at scale. And this is where we're leveraging technology like AI and machine learning. And CPGs today are literally swimming in data. We have social media data, we have e-commerce data, and thank goodness now we have AI that helps us make sense of this data so that we can literally offer up to a consumer the right product at the right price with the right offer at the right time. And we're really excited about this technology. The ROIs here are quite good. And working with our partners at Amazon, Google, and Facebook, we've built a pretty nice data management platform. And a lot of CPGs are looking at this as really the next wave for the future.
Because it's a mountain of data, and it's like if you don't know what to do with it, then it's useless.
And really, this is one of the benefits of kind of the pivot to digital. I mean, today the way we build brands is very different than the way we did build brands. Today, it's not unusual for CPG to have 40 to 50% of their budget now in digital. And what's new about that is we have access to all this data. We know where you browse online. We know what you buy online. We know if you looked at our category and didn't buy our brands. And so the ability to leverage that data in a way to serve up relevant messaging and to develop product sets for different consumer segments is a game changer, we think, and a way that big brands and iconic brands like Oreo, like Triscuit, like Ritz can really take advantage of the equity that they've built over the years.
Because that really is a game changer, right? You might, at this point, somebody that's shopping in a Kroger, in a brick and mortar grocery store, you might know that, okay, this person was in the store on June 7th and they grabbed a box of Ritz, but you probably wouldn't know their gender, their age. Now that person is online, you might know that they searched cookies but decided not to buy Oreos. So, I mean, that is just a different world as far as what you know about who these people are and their shopping behaviors.
Yeah, it's really changed the game. And again, it does require some investment and some time to learn how to perfect this, but we think it's a great investment for brands to make. And you know, consumers are certainly not spending any less time in digital or on mobile phones, so we think it's the future.
One of the things that I hear differing opinions about is big brands versus small brands online. You know, the people that I guess are touting the small brands are saying that's where customers go to find flavors of their favorite snack bar that they can't find in the store. So it's going to help the smaller brands because maybe there's less slotting fees or there's an infinite shelf. And then people from the big companies tell me, well, if somebody searches cookies, it's going to come up Oreos. So how do you think that all plays? And I mean, is that the right question to be asking even about whether it plays better for big or small brands?
Yeah, that's another issue that we're dealing with, and you know, the big brands. I'll say this: you know, Oreo's the #1 cookie online, Trident's the #1 gum online, Hall's the #1 cough tablet online. So there is big brands still command share domination online, but that's not to say that smaller brands and private label haven't had success. I mean, clearly the barriers to entry are a lot lower online. If you take a look at Amazon and you analyze the category of cookies and crackers, about 50% of the share is spread across 500 small brands. So they are having some success there, and they're tailoring the offering to the needs of today's millennial consumer. Millennials like to go online and discover new things. They like natural, organic, and health and wellness is very important. So they are having some success there, and we acknowledge that, and we're developing through our portfolio a lot of health and wellness product as well. So you'll see big brands begin to accelerate, I think, what they're doing in that space as well. The other point I'd make is big brands can do the same thing, and we can do it just as effectively as a small brand can. So we are looking to e-commerce as a new platform for innovation. I mentioned direct-to-consumer as one environment where we can do a lot of innovation, but we can do the same thing on Amazon. So we're doing a lot of testing and learning there, and you'll see CPGs begin to rethink the way they do innovation because it's faster and cheaper, and I think we can really kind of explode our innovation pipeline by leveraging e-commerce.
And does that mean specifically that you're thinking about this new channel where you're saying a big chunk of the growth is, and you're actually thinking about tailoring products to fit the characteristics of the person that is shopping that way?
We are. We're also selling our regular full assortment, and oftentimes we will have to develop different types of packaging that work just right for the channel. But we're having success with our core assortment, and our core brands are selling quite well online. But there are opportunities to do specific innovation plays, and we're doing that as well.
You talked about Walmart and Kroger. Yeah. They've obviously, two giants that really got woken up, I think, by the Amazon Whole Foods deal. So those are brick and mortar retailers that now have massive and growing e-commerce operations. How are they different than Amazon, where Amazon is a pure play e-commerce? Yeah. Obviously, they have some stores now, but I guess how do you think about the brick and mortars as they push into e-commerce?
Well, I think Amazon's purchase of Whole Foods was a good indication that omnichannel is probably the strategy that's going to win over time in this space. Penetration for food and beverage online will peak out probably. I don't know if it's 20%. I don't know when it will hit that, but it's going to accelerate and grow pretty quick, probably to that rate. Some people think it'll cap out at 15. So there's still going to be a lot of consumers who still prefer to buy in brick and mortar, especially fresh foods, right? That you want to take a look at before you put them in your basket. So I think the omni-channel play, if you really want to win in grocery, you've got to be an omni-channel player. And Amazon is doing that, whether it's Whole Foods, whether it's their Go store, or whether it's the, the 4 platforms that they have now, grocery, fresh, Prime Now, pantry, they're going to continue to innovate. I think today, the other thing that I would distinguish is that Amazon's got a very rich digital ecosystem play. They have a very sophisticated media and data offering for brands. Consumers now go to Amazon more than Google for product search. So Amazon is a destination platform. The omnichannel retailers aren't there yet. So as a player, as part of the digital ecosystem, I think Amazon's a little further along. But I think omnichannel is a strategy that's going to win.
So that means that the person that's searching out non-GMO cookies, that search now more and more is starting at Amazon rather than Google.
Right.
Yeah, it's pretty interesting. And it's interesting the way that allows them to kind of lock in those customers and where it goes from there. I mean, anything else at all that that's important that I haven't asked just about this?
Well, I think looking ahead, we're both excited and have a little bit of anxiety about voice. Voice search is dramatically growing. I think about by 2020, 50% of all searches will be done through voice. Wow. And that's going to really present brands with some new challenges because brands have built equity around appealing to consumer brains, right? But in a day when AI and personal assistants are doing the grocery shopping, they're going to look at consumer shopping behavior, and the decisions for what gets on your shopping list will be made by Alexa. So brands are going to have to figure out a way to influence a platform like that. And that's going to be an interesting new paradigm for us. And I think it'll be here sooner than you think. So that's something we're watching very closely. Certainly Amazon and Google will commercialize opportunities to market on those platforms. They're just beginning to do that now. But we've got a watchful eye on voice. We think that'll be another big disruptor, in the business going forward.
So that's Alexa, buy me cookies, and then the Oreos show up.
Yeah, you've got to be number one or go home.
Right. Well, Jeff, thank you very much. It was a great chat, and we really appreciate you being here. Thank you very much.
Thank you.
All right, thank you very much, Craig and Jeff. If Tony Robbins were here, you'd all be going like this, right? Now comes the most exciting part of the evening, economists. I say that because I'm one of them. We want to look now at where we are in the global growth cycle, and we promise we'll stay away, hopefully, from the baseball metaphors. But I mean, as I said, the numbers are good. The headline numbers pretty good, 3.5% growth maybe this quarter. Could be north of that if we get a few more good numbers in. But a lot of threats out there. Tomorrow morning, Donald Trump goes to Quebec, going to get beat up by the other members of the Group of Seven. He tweeted just before we went on, bring it on. Trade war, very much a possibility. Emerging market volatility is rising. We're seeing effects from the strong dollar. We're seeing effects from the issue of what's going on with China in its sphere of influence in Asia. Brexit, obviously a big concern today. A lot of stories about that. And then we throw Italy on top of that. A lot of things to worry about. So I want to bring up my panel now, and we'll get into that and look at what it is that we have to worry about and how much we have to worry about it. So if you all come on up and join us on stage here. I will introduce everybody from my right to their right, your left. Christina Hooper, she is the Chief Equity Strategist, Chief Global Market Strategist at Invesco. John Riding, he's the founder, Chief Economist at RDQ Economics, and Peter Hooper, the Chief U.S. Economist at Deutsche Bank. And for the night, John has agreed to change his name to John Hooper, so it's all kind of fits together. I know you guys probably had the same experience as I did when you went to graduate school for economics. One of the first things they tell you is you can make a numerical forecast or you can make a time forecast, but never make the same at the same time. And I want to violate that tonight. And stay away from the baseball metaphor since it's the Stanley Cup playoffs tonight. We'll use a hockey metaphor. First, second, or third period for an expansion that is now very close to being the longest in history, but is faced with the big number of threats that I brought forward. We'll just go for this first question on right to right. And Christina.
Well, it's always a problem when you ask sports metaphors of non-sports fans. So I don't have a huge amount of knowledge when it comes to sports with the exception of basketball. But what I can tell you is that certainly the economy is in the later stages. We're already at 107 months of economic expansion in the U.S. specifically. So it's not a synchronized global recovery because we're at different stages. Different countries are at different stages. Brazil is just a few months in and may be ending very soon as well. But if we're talking specifically about the U.S., we are getting close to the end. I think we can get to a little over 120 months, which is the longest economic expansion we've had. I don't see us going that much further than 120 months, though.
John, how much time left on the clock?
Well, I'm more of a soccer guy than a hockey guy, but I think that we were, prior to November of 2016, we were pretty much at the end of the third period. I really do think the corporate tax cut has reinvigorated the economy. The deregulation has helped reinvigorate the economy. And what looked like a recession-like squeeze in profit margins has been really helped out by this shift in corporate taxes. And so I don't think expansions die of old age. And I do think, therefore, I don't know, what in playoff hockey, I guess you keep having multiple overtime periods until it ends. So I think we've gone into overtime, but it could be quite a number of overtime periods potentially before this comes to an end.
Peter, you don't have to stretch the metaphor. What do you think about the timing?
Well, for the sake of diversity, I'll say something different here. It's our official forecast is that we're sort of midway to late through the second period, with a risk that we're midway through the third. And I say that because we're not over-investing. We're not at late cycle in the housing market. We're not late cycle in business capital. There are no real overhangs of investment. They're going to bring this expansion to an end. The big risk is labor market tightening and a good old-fashioned Fed-driven downturn because inflation finally begins to take off. We're forecasting that for the first time ever, the Fed's going to be able to achieve a soft landing and that we'll have a growth recession in 2020. Growth will slow to maybe 1%, but maybe they can escape a good old-fashioned two-quarter decline in GDP, absolute recession. The risk is that inflation does pick up a bit stronger. The Fed has to slam on the brakes a bit more aggressively, and then we do get into an outright recession in 2020. But our baseline forecast is that maybe Jay Powell can find the magic here, and the Phillips curve is flat enough, inflation pressures are out there far enough that we don't actually go into a real recession for some time to come.
Well, whether you believe his forecast or not, his analysis of inflation is right on, John. Where is it?
Well, the cost pressures that Peter was referring to can play out in one of two ways. And depending which asset class you're interested in, you're going to root one way or the other. We have suffered a squeeze in profit margins, and that is normally an expansion killer. That went through from late 2014 through to the early part of 2016. Since then, profit margins have stabilized, but the underlying conditions that produced the profit squeeze hasn't gone away. So one of two things can happen. We can get the wage pressures as the labor market continues to tighten. And I fully expect the unemployment rate to fall to 3% by the end of next year. If companies can't pass that on and we don't get the inflation, then the squeeze in profits will be the factor that ends this expansion. If we do get higher inflation, I think we do get higher inflation, then I think we can have a longer wind down. But there's an underlying dynamic that with low productivity growth, that unless we get a resurgence in productivity growth, these labor costs are going to be a problem one way or the other, whether it's for profit margins and a bigger problem for equities, or an inflation and a bigger problem for bonds. We'll probably get a mix of the two, but I don't count inflation out. The last time we had conditions like this on core inflation was the first half of the 1960s.
Well, Christina, do you worry about a rapid acceleration in inflation? Do you position for that? Or is it just going to kind of be steady as she goes?
I think we have to name that as a risk. I don't think it's the base case, but I do think there's an outlier chance that we could see a rapid increase in inflation. And that has a lot to do with the jobs recovery. What we saw was for years a very low quality jobs recovery, where if Americans who were unemployed got jobs, they typically made less than they were making before they lost their job. And so for a long time, we didn't see any wage pressures. Now that we're down to 3.8% unemployment, really in the last year, 2 years, we've seen the quality of the jobs recovery improve such that an American today who's getting a job is likely to make more money than they did before the global financial crisis. Now, that doesn't mean that there's a lot of wage pressure, but it does mean we could see a lot of wage pressure in the coming months. And so that certainly is one area that could contribute to inflation. The other, of course, is input costs. You had mentioned the summit tomorrow in Quebec. It's going to be all about trade and, in particular, protectionism. We already saw in the April Federal Reserve Beige Book that business owners are talking about input costs increasing because of the aluminum and steel tariffs. And that was before they were applied to the European Union, Canada, and Mexico. And so we do have the potential for input cost increase as well as wage growth.
Let me ask you both, the trade issue, how much of a threat is it to the U.S. economy at this point? I'll start with Peter. Classical economics would tell you that, yes, this is a major threat. We haven't really seen it so far.
Economists don't like to see this tariff action, don't like to see retaliation. This is a lose-lose game. But I mean, forecasts on the street have not yet changed. Our own forecast remains growth at close to 3% this year, slowing to 2.5% next year, and then a growth recession in 2020. But the risks associated with what's going on the trade front have certainly risen. I mean, when you actually go to the point of imposing a tariff on steel and aluminum, this is at one sector. It's not a big macro issue. It comes out to less than 0.1%. Direct impacts on GDP negative, although there may be some upside risks. If it stretches into a conflict with China, if we go to 50 billion imports, 150 billion imports, if there's retaliation, and we begin to move up, and certainly if we do something with NAFTA that is undesirable, then you're moving into the area where a real recession possibility comes up. But the assumption is that the administration recognizes these risks, does not want to tank the stock market, does not want to tank the economy, and they will stay away from that.
Do we tank, John? Is that much of a possibility?
Well, the problem is, and we talked a little bit about this yesterday, is the lack of a strategy, or at least a strategy that can be understood. So businesses like certainty. So people say, we had the corporate tax cut, where's the big pickup in investment spending? But we've had a big pickup in policy uncertainty. So to your first point, it's a low probability tail risk with a really bad potential outcome. I'm not saying it's Smoot-Hawley, but do remember that those tariffs played a role in the run-up to the Great Depression. So the problem is, what's going to be the retaliation? What's going to be the response? And I think that the worry, and there's two factions in the White House. There's my former colleague, the person who brought me to Bear Stearns many years ago, Larry Kudlow, in the role of the director of the National Economic Council, and he's a free trader, right? And then you've got Peter Navarro, who thinks that you can boost GDP by depressing imports, which is a sort of 1970s recipe that didn't work in the UK, but was advocated and wouldn't work today. And those two forces are fighting it out. I'm hopeful that rationality prevails, but it is a risk, and until that uncertainty is cleared up, it's going to be a risk that hangs out there.
I get that from Fed Bank presidents that I've talked to many of them over the last couple of months. And Christina, they all say the CEOs in their districts are telling them that maybe they would take advantage of the tax cuts and the expensing, et cetera, but they just don't know what's going to happen. Mm-hmm. Is that what you get from the companies you cover?
Absolutely. And we see it if we go back and chart out economic policy uncertainty, because there is an index that tries to represent that, and we plot that against business investment, what you see is that there is very strong relationship, and it's a negative one. And so as economic policy uncertainty goes up, as John pointed out, we're going to see less and less business investment, and it's running counter to what we would expect given that tax reform legislation. And it's certainly something that I hear, and I also hear a lot of talk about the concern about tariffs. Now, John had mentioned that he believes it's low probability. I'm not sure it's that low probability that this could happen this way. Because what we know about the Trump administration is that that's one of the longest held views of the president, is a protectionist, anti-free trade, essentially, viewpoint. And so I think there's a very good chance this situation could get worse, not better. We know tariffs are like bacteria in a petri dish. They multiply fairly quickly, and we're already starting to see some of the threats coming from our closest allies because they're angry. That's coupled with what is a confused trade policy on the part of the administration. Not only do we have those two opposing factions, but we have an administration that hasn't prioritized its objectives. Now, at the top of the list should be intellectual property violations from China, but that seems to have gotten mixed in and muddied with trade deficits, which a country you would assume like the United States is likely to run trade deficits with a country like China. And that is not a priority relative to intellectual property violations. And so I think that this is a strategy, a policy that is a set of policies that are very confused, run counter to each other, and really could result in a higher probability, high-risk event.
Speaking of high-risk events and Donald Trump, we have the Singapore summit with the North Koreans coming up next week. John, is that a market economic event, or is that just political at this? I mean, leaving aside the possibility of a nuclear war, which sends the Atlanta GDP tracker to zero, what are we to think of that?
I don't know. I mean, I don't know how to quantify risk on, risk off. And obviously the potential is that it goes out. My sense is it's maybe not a big issue for the market. The problem is the lack of clarity of signal in the markets. And the big lack of clarity of signal, from my mind right now, is profit growth. And without a lack of clarity of signal, then the noise can overwhelm that signal. Like, for example, as it did in the events in Italy last week in terms of the bond market. Is there if that was resolved, and let's say there's going to be another set of talks and things look good and there's going to be progress, would that spur a big move up in the market? My sense is probably not. You'd get a bounce for a day, but lack of clarity of what really should be driving the markets, which is underlying profit growth.
But Peter, are we going to see profit growth pick up? Is this just kind of a normal pause that we're seeing as we consolidate, and then we start to make more money if the economy is picking up, or do we see business stay on hold and consumers uncertain and the top line doesn't really grow that much?
Earnings have been doing great. I mean, very good numbers, very strong numbers in Q1, and the kind of macro economy that we're looking at for this year for the U.S. says earnings numbers should continue quite strong. And I mean, we're looking for S&P getting to 3,000. I mean, we're looking at a macro economy driven by fiscal expansion in the face of some risks, no question. I think on North Korea, we've already had the beneficial effect there. That's come off most people's risk list. Pretty remarkable shift there. That could come back on depending on what happens in Singapore. But replacing it has been obviously trade and Italy, but not to the point where it's having a substantial impact yet on earnings prospects. I think the biggest risk for earnings really is coming back to the first issue, the inflation pickup, labor market tightening, demand growing a lot faster than supply, unemployment rate getting down in the low threes, looking at wage inflation rising with productivity growth still pretty slow. That's going to begin to eat into earnings, but probably not until next year. And as the Fed gets into action, raising interest rates, slowing growth, the risks there become more of a factor.
Well, Christina, are you as optimistic about as Peter is about Jay Powell's ability to bring us in for a soft landing? Do you believe the slow, steady pace argument?
I think there is certainly the potential, and I would say it's probably my base case, but I think the risks are greater perhaps than what Peter perceives them to be. And that's really because I think that this is a different FOMC than the Janet Yellen FOMC. I believe in particular Jay Powell is not as positive on QE and is not as positive about having a very large balance sheet. And so to me, one of the big risks in terms of a monetary policy error this year would be that the Fed focuses on accelerating balance sheet normalization. Now, it's already on a preset plan to accelerate throughout the course of the year, and we've heard some rumblings from the Bank of India that they hope that we don't do that. But we could actually see that balance sheet normalization accelerate even more, given that historically, if you go back to the 2012 transcripts of the FOMC, what you hear loud and clear from Powell is pushback on QE3. Janet Yellen's pounding the table, trying to get everyone on board, and he's worried about the size of the balance sheet. So he's uncomfortable with the size of the balance sheet, coupled with that we saw a number of participants in the most recent minutes are concerned about an inverted yield curve. Well, if you're worried about an inverted yield curve, you may say, let's only raise rates 2 times more this year. Let's focus on accelerating balance sheet normalization, and then we'll get some breathing room in the gap between the 2 and the 10-year, or the gap between the Fed funds rate and the 10-year. So I think that could cause some kind of disruption to markets, particularly equity markets.
Well, John, do you worry about an inverted yield curve? And more importantly, do you think the Fed really worries about it?
I think there is some concern. I just want to push back. I think the Fed's been very clear. It doesn't view unwinding the balance sheet as an active policy instrument. And by the time the caps get to $50 billion a month in the fourth quarter of this year, that sets you off for about the caps won't fully buy, but something like a $500 billion runoff over the next year. So I think they're going to be more active on the funds rate. Now, will that funds rate, and I think the Fed raises rates 4 times this year, and I actually think that they've clearly signaled now they're going to go into overshooting. I see them raising rates a similar amount next year. Does that invert the yield curve? My guess is no. And for 2 reasons. Firstly, fiscal deficits are going up, and coupled with the fact that we can't keep playing this game of issuing more T-bills, coupon issuance is going to go up more than the deficit. There's going to be a lot of long-dated paper coming into the market through the fiscal deficit, through the balance sheet unwind. And so I think that those 2 factors will cancel out the flattening effect of the curve. Fed is concerned. They're more concerned of the yield curve inversion if it happens as a signal, not as a cause of recession. I don't think so many people buy into the idea that inverting the yield curve causes recession. And I work very closely, actually, at the New York Fed with Arturo Estrella, who was the guy at the Fed who basically spent years working on the yield curve as a signal. My guess is long rates will move up, and we'll kind of have the curve that we have right now for at least another year. If it inverts, though, it's a get out of Dodge signal. It's pretty much been reliable as a recession 12 months down the road signal. I won't fight that one.
Well, then we'll go somewhere else in the world, which is my segue into asking about the rest of the world, because we've only got a few minutes left. I want to touch on some other regions. And Peter, since you represent a German bank, I'll give you this question. Europe, the ECB, considering whether to get out of the QE business finally. What are the prospects for European growth? How are they affected by trade and the trade wars and the political issues that have now come back to the fore in Europe?
Yes, the European economy is not quite as robust as it was last year. Things slowed a bit, but it was unsustainably high. It's come down to something still above trend. We do expect it to continue, and I think the ECB has been giving us signals very recently that things look good enough to get on with beginning to end the QE. I think we could get something at the next meeting on that score, which is a little bit ahead of what people had been assuming. Yes, the Italy risk has been a negative, but that looks manageable at this point. Yes, the trade, as Christina mentioned, is having some negative impact on investment, even in Europe. But overall, the economy there looks strong enough for the ECB to get on, and inflation's come back enough as well. So I think
is inflation as big a threat there as it might be here?
No, I think they have a good ways to go on core inflation. They have a good way, somewhat further to go on labor market before that becomes an issue in terms of overheating. That's not the case. If I can take 30 seconds of time on the yield curve, I really do think, if I can disagree with John on this one, that we think the yield curve will invert second half next year. That doesn't necessarily imply a recession. Term premiums are so much lower than they have been historically that yes, it's been a very reliable indicator in the past, but I think times have changed in terms of where term premiums are because of this balance sheet expansion. As they normalize over time, that's still some ways off, then it becomes a clearer signal for recession. But I think yield curve inversion in the second half of next year, mild one, does not necessarily imply recession.
Oh, we actually agree. We just think the term premium unwinds faster and we don't get the inversion. I agree with you.
Peter has a longer-term lease in Dodge City. You mentioned, Christina, the emerging markets. You worried about Brazil. We're seeing a lot of volatility in emerging markets these days. What's your outlook?
Well, actually, emerging market stocks from a valuation perspective look attractive. I would argue, though, that given the kind of environment we're in, where a number of emerging markets countries are coming under pressure because they have dollar-denominated debt, this is a time to be very discerning in the emerging market space. Be very selective. Focus on specific countries. To a certain extent, focus on specific companies within those countries. But we're seeing, for example, very nice growth coming out of India that I think is actually going to accelerate over the next few years, helped by the reforms that have been put in place over the last several years. And so that's an area that I would focus on if I were to name one country. But in general, I think we just have to be a lot more selective and careful wherever we go, but particularly in the emerging market space.
We know Argentina is troubled. You mentioned Brazil. Is there any possibility that we see, with all these countries with dollar-denominated debt, a repeat of the Asian financial crisis?
Well, we certainly could see something like that, although I don't think we're going to see anything of that magnitude, just because I don't expect the dollar to strengthen that much. I expect the Fed to back off. My base case is that we won't see a very hawkish Fed. I think for the most part, what's dictated dollar strength or weakness over the last several years really has been expectations about the Fed.
John, I saved Asia for you. Japan and China, what do you see happening?
I think that as far as China is concerned, and then, there's big uncertainty in relation to trade. They've proved very capable of managing the growth. If there's a problem there, they've still got in excess of $3 trillion in foreign exchange reserves, which is a sum of money that no country's had on hand to deal with a financial crisis in the past. So my guess is that China manages 6 to 6.5% growth going forward. Japan is just a different animal. I mean, we talk about the lost decade in Japan, but that lost decade was 2.5 decades ago. So does Japan escape its disinflation, deflation pressures? It's got a far worse aging population dynamic than Europe or the US. I think it's very difficult. So the Japanese firms may do very well, but the Japanese macroeconomy, I think, is very different from the from the rest of the G7, and they'll be continuing their QE for a lot longer than the ECB or the Bank of England.
All right, we have a minute and a half left, so I'll give you each 30 seconds. I'll start with Peter. This time next year, what will have happened that we weren't expecting?
This time next year, what will have happened? I see the two biggest risks that what would be totally surprised would be, number one, we do begin to see some real inflation push. Certainly there are a number of things that the Trump administration has been doing that are helping to move things in that direction. I did an op-ed in the Washington Post yesterday on that exact topic. But on the other side, maybe we begin to see something positive on the supply side. These tax cuts combined with a lot of R&D, a lot of innovation potential. We heard a little bit earlier about AI and machine learning and whatnot. Maybe we do begin to get a real increase in productivity. What's been hurting everything globally, whether it's Japan, Europe, the US, is extreme low productivity growth. If that begins to go the other way, that says that this expansion has a long way to go.
John, very quickly.
All right, I'll try and save 5 seconds here. The thing that we're not expecting, global conference, England wins the World Cup.
There's a sports prediction for you. What year? No, I don't want to hold you to that. Christina.
Full-blown trade wars and actual reforms that occur in the European Union, helped by what's going on in Italy right now.
And there you have it. The standard economic situation of, on the one hand, on the other hand, let's give a big hand to our panel. Thank you very much. All right, for the next portion of the evening, we're going to drill down into equity markets, take what we've learned and see where we kind of go from here, where we are, where we kind of go from here. Growth stocks have dominated their value peers over the last few years. The trade's dominance, though, relies on more than just tech stocks. Too easy to just say it is all tech. So here to take a closer look at whether the trend continues, what drives it, what might stop it, is Kevin Kelly, Bloomberg Intelligence equity strategist. Please welcome Kevin.
This on? Good? Perfect. So as Mike mentioned, my name is Kevin Kelly. I'm a U.S. equity strategist with Bloomberg Intelligence. A very quick plug for those who are not familiar with Bloomberg Intelligence. We are the research arm of Bloomberg LP. You can find our research on BI Go on Bloomberg Terminal, if any terminal users out there. And what we basically have is 275 analysts who cover a number of different credits, equities, a number of different industries. We also have strategists such as myself that cover anything from equities to emerging market credit. So a very robust offering. Highly suggest checking out BI Go. What I'm really here to talk to you today about is the value versus growth trade. And so what we can see in this first chart, I just want to set the stage of where we are today. So what we've seen in the past over the last 30 years or so is there's been periods where growth's outperformed, there's been periods where value's outperformed. Leading up to the late 1990s, early dot-com bust era, we had tech really driving growth. You can see the outperformance there. I apologize, they're a little small, so I'll try and talk through them. In the subsequent years, from early 2000s to 2007, you really had value leading growth. And so what we've seen now, if we fast forward to today, is that dispersion between the growth value trade has really, really widened over the last couple of years. And so what I'm going to give you is our outlook for if we think this can continue. Spoiler alert, we do think it can continue. And the reasons why. So the key is the outlook growth. So when we came into this year, it seemed as if conditions were pretty ripe for value to start outperforming, right? You had inflation expectations increasing, pushing longer dated yields up. You also had oil prices rising. So there are a number of different factors you would have expected value to outperform growth. So the keys are growth outlook here, and why we think this trade on a relative basis can continue. The first is simply stronger earnings, expected earnings growth for growth stocks over value peers. Second is conditions where valuation multiples are expanding, which we've seen this cycle, obviously. And then the final one is the breadth of the style outperformance, especially on a sector level. I'll get into that in a couple of minutes of what I mean. So the first one, it seems very simple, but oftentimes it's forgotten when we're trying to keep up with the daily headlines, watching the different market moves, the daily volatility. Over the longer term, we know that stocks trade with earnings. They trade with the expected future earnings growth that these companies are expected to have. And so what we see here, and this goes back to about 1995, this is the Russell 1000 growth index over its value counterpart in the yellow line, and then in the shaded white line is the expected earnings growth for those different indices. And what we can see is that in that period that I mentioned where value outperformed in the early 2000s through 2007, these companies were actually growing faster. Their bottom line earnings were growing faster than their growth peers, and hence they outperformed. Well, we can see if we fast forward to this cycle, and especially recently, growth's really taken off against value. But a big reason for this is because expectations for EPS growth and that bottom line earnings growth continue to accelerate for these growth stocks compared to their value peers. So that's our first key. Now, how do we know that growth stocks are really being driven by earnings? We got a great function on the terminal, FTW. It stands for factors to watch. And what you can do with this is you can essentially take an index or a group of securities, type it in, and figure out exactly over what time horizon the strongest factors that are driving that performance. And so we can see here, this top one says 1 year forward EPS growth, the percentage. So what we know is that one of the top factors over the last, and this is a 12-month time horizon, we know is one of the top factors driving this Russell 1000 growth index, which I'm using as a proxy for the rest of the market. We know that EPS growth and the forward expectations for it are really driving these stocks. So really hammering home on this earnings point. The second key is situations with multiples are expanding. So it's difficult to not address multiples. Yes, valuations can seem a little bit stretched. But what we believe is that until you really see a rollover in market multiples, here represented by the price to earnings ratio on the S&P 500, until you really see multiples roll over, take more bearish bearish levels or move into roll over into bearish levels, you're really going to see growth continue to outperform. Now, we did see in the early 2018 this recent price correction in the overall equity market in the U.S. And what we think is that that correction really brought multiples back near these 5-year averages. So there is the argument that, yes, we don't think multiples are going to expand drastically as much as they have maybe earlier in this cycle, but it is an environment in which you could see multiples expand a little bit, especially as the market starts to turn more towards profitability and really harping on these companies that are growing earnings faster than others. The last point I wanted to make about our outlook is it's not just a tech story. Oftentimes, technology shares are kind of the real harbinger for why, or the excuse for why growth is outperforming its value counterpart. And while this is definitely a large part of the trade, it's not just a tech phenomenon. So what we have here is a Russell 1000 value index minus its growth peers on a sector level. So what I'm looking at is the performance of all the sectors, their growth counterparts versus their value counterparts. And what we can see is that in discretionary financials and even industrials, over the last 5 years, the growth counterparts in those sectors have outperformed their value peers by a larger percentage than even in the infotech space. So the big point here is that it's not just a tech story. This is happening sector-wide. Another point we wanted to make is that some of these traditional value sectors, right, and I'm going to use growth as a good example, may actually even warrant a growth tilt within the portfolio. So yes, a pickup in oil prices, rebound in oil prices, energy shares have done well, especially recently in the last 6 to 12 months. And it is true that value has a higher allocation to this sector than growth does. What we wanted to point out is that when you have a situation like this, and if you expect oil prices to continue or even remain relatively at bay where they are, we expect energy growth counterparts, right? So the growth stocks within the energy sector to outperform their value peers based on history. There's a pretty reliably consistent positive correlation between growth energy stocks outperforming their value peers when oil prices move higher. So again, a traditional value sector that may actually warrant a growth tilt to it. Finally, one of the points I want to make is there's a higher allocation to these yield proxy sectors, which we just simply do not think are going to perform on a relative basis as well as growth stocks will over the next 12 months. And a big reason for this is rates rising. So the dividend yields that these companies offer simply just gets kind of competed away as these fixed income alternatives start to rise as well or become more attractive. And the second is that a lot of these companies are much more indebted than other sectors. And what we've seen in the broad equity market is a move away from companies that have high leverage or high debt ratios to companies with lower ones, as well as this focus on profitability. It's really accelerated over the last 12 months. So really quick, what are some of the risks to this growth style? Or what could make value outperform, whichever way you want to look at it. So one of the keys, again, going back to valuation. Yes, valuations look a little bit stretched, especially when you look at a growth versus value comparison. So in the yellow line here, I've got the Russell 1000 Growth over Value Index comparing their price to book ratios. So if you look up on price to book basis, we're back near levels where we're at the late 1990s, early 2000s. When you look at it in the white line, which is on a price to earnings basis, a forward price to earnings basis, that premium isn't nearly what we saw, almost 2 decades ago. And so what we think is that, again, if we expect earnings to continue to grow faster for these growth peers, we think that this valuation premium can remain relatively at bay. And it's not at, the crazy scary levels that we saw, again, during the dot-com bust. Tax effects, this was just talked about in the last panel. This was taken right before the corporate tax reform went into effect back in December, which cut the corporate tax rate. But essentially what we saw is that heading into this, value companies had a larger effective tax rates than their growth counterparts. Now, you could make the argument that a lot of this may be priced in, especially priced into earnings expectations, but it'll be interesting to see what the downstream effects are of some of these tax savings, whether it's shareholder-friendly activity like buybacks and dividends, or paying down leverage. As I mentioned, some of those yield proxy sectors are more highly indebted. So the downstream effects are definitely something we'll be watching for as a potential risk. And the final one, again, that was touched on the last panel is higher expected inflation. But in my opinion, this is more so of a sector-specific play rather than a value versus growth play. What I mean by that is you could see some of these value sectors outperform if inflation, again, isn't crazy high, but is moderately higher moving forward. You could see some of the financials or the commodity-sensitive sectors outperform, which could get a lift to the value trade. Now, why I say it's sector-specific and not necessarily value versus growth as a whole is because, again, going back to those yield proxy sectors, which have a higher allocation in the value style, those are going to be hurt by rising inflation expectations, rising yields. So hopefully got a quick outlook on what we think. If you have any questions or we have any critics, I'll be around for the rest of the event. I'd love to hear what you guys have to say. Another quick plug, you can find our stuff at BI Stocks Go on your Bloomberg terminal, or you can just reach out directly to us. So with that, I will leave you for the last panel.
Thank you very much, Kevin. All right, let's stay on the topic of investing and markets. Obviously, you all know that volatility has come back. We're out of the great flattening and moderation. So let's talk a little bit about what's causing that and where we go from here, how you invest in that kind of climate. Across markets, across categories. Here to help us do that is Ellen Ellison. She's Chief Investment Officer of the University of Illinois Foundation. She helps oversee a 6-person investment team, a portfolio of nearly $2 billion. And Mark Levine, Chairman of the Illinois State Board of Investment, $22 billion on behalf of 140,000 state employees. Welcome. We know that what you see kind of depends on where you sit and what your obligations are. So let's start by each one of you giving us a little bit of what your investment philosophy is, what you're looking at, and where you do want to invest, as not specifically opportunities, but the kind of things that you're focused on.
Thank you. So we're here in Chicago. We support through the foundation all 3 universities within the University of Illinois system. And the endowment is rapidly growing, which is terrific. And today it distributes very little relative to the overall budget. I'm sure we have a lot of Illini's in this room, but we're interested in growing this endowment, both through compounded earnings and investment and also through an increase in private philanthropy. It's a concentrated portfolio with 39 mostly active external managers And we have a very strong value bias, which has been quite lonely and painful at times. We believe in active management and focus on net returns net of fees. And we've been very successful since starting this program about 5 years ago. 5 years is young in the life cycle of an endowment, so we still have a long way to go before we can consider ourselves at the level of some of our more well-established brethren. It is a very growth-oriented portfolio. It is global in nature, and we have a very simple asset allocation hierarchy: 63% global equity, 17% global credit diversifying strategies, and 20% things that go bump in the night. So the risk hedge area when nothing else is working. And the performance has really been very, very strong, mostly through the public market portfolio over the last few years.
All right, Mark, I think you have a little bit of a different approach.
Definitely, yeah. Thanks for having me, by the way. Our core philosophy at our Illinois Pension Fund is simplicity, and there's just no need to make things more complicated, right? Index funds beat 93% of active managers, so why would we waste time trying to find that sort of needle in the haystack? And by the way, that's 7% that outperforms. That could be outperformance by a basis point. Who needs it? Why dedicate resources to that? So that's really a core philosophy of ours. Our portfolio, now, that's not to say that we're not going after alpha, because we are big time, okay? But we believe that alpha comes from process, not from these directional kind of, concentrated bets type thing. So what I mean by process is, if you think about like private market assets, where we're actually going much heavier into things like opportunistic credit, opportunistic real estate, special situations, that sort of thing. Not so much private equity. We're kind of actually almost on the low, I would say on the low end versus our peers on private equity. But a process where where you're investing with somebody who actually is originating the assets directly. They're entering into bilateral negotiations. They're getting kind of, let's call them special deals, right? So as an example, our opportunistic credit bucket, and by the way, this is not like lending to private equity owned businesses, which is often kind of treated this way. We have a little bit of that, but this is really kind of all sorts of odds and ends. It might be distressed mortgages, that sort of thing. Our target returns there are actually double digits, maybe even low teens. And I'm talking about first lien, unleveraged type risk. It's actually much lower risk than public market equities, and we're getting what we expect to be higher returns.
All right. Well, let me ask Alan then. What's wrong with that philosophy? Can you make more money your way, and why? I guess is the real question.
So I think size is size and very well-defined liability streams that my colleague is faced with are the two determinant factors in his approach. I believe if I were in charge of his portfolio, I probably would pursue a highly passive or index strategy. So you have to play the cards you're dealt, and there's some tremendous benefits of being small at $2 billion. We are big enough to write a $30 to $50 million check to anyone, and we're also small enough to put someone in business, so that I am not alone in CIOs of endowments who believe that we can, in fact, beat active management, and we do it by being different, being smaller, being pre-institutional, being very early, and oftentimes, as was the case in 2013, 2014, I was the only person kicking around Japan back then. It was very lonely, so that certainly with a long-term and contrarian bias, one can be very successful. The other advantage that I have is that we do not have any liquidity restraints. Thank goodness the amount of donations that come in any given year are more or less equal to the outflows that we send to the university. I don't really see how one could hope to meet a minimum required return of 5.45% plus inflation without a very different and heavily growth or equity biased portfolio. finally, we don't really care about volatility. We don't think of vol as risk. Our biggest risk factor is not meeting the minimum required return.
So. Is vol risk?
Not for us. No, we're a long-term investor. We sort of like volatility. Right? It kind of, to me, volatility is actually insurance against bubbles, and so we sort of like to see that. We will never make a change based on standard deviation. Remember, investment returns actually don't follow a normal distribution. So this fixation on standard deviation is a complete waste of time. It actually will lead you down many blind alleys. By the way, there's a couple things that besides that I actually quite agree with here. Size is a very big issue. Okay, and there's this thing that I call AUM disease, right? And I'm not alone on this. Actually, this is part of really like Yale University endowments philosophy. It's what it is the typical pattern is some sort of brilliant investor, and I mean that brilliant investor might raise 300 million, 500 million, something like that, be able to invest it very successfully and just not really knock the ball out of the park. Okay, and then what inevitably happens? The consultants and the institutions pour in. They've got $10 billion, okay? And then they end up just tracking the index. That is a recipe for failure, right? Because in the end, the way they're monetizing their success is through these 2% management fees or 1.5%, whatever the heck they're at now, and which doesn't do anything for us. So we are very much believers. And one thing that we've done because I mean, actually, I think I'd prefer a $2 billion portfolio to our DB plan is $18 billion. We have a DC plan that's $4 billion. One of the things that we've done is by indexing 2/3 of our assets, do the math. What's left is $6 billion. Okay, so $6 billion, you can start to kind of maybe get maybe that's $100 million slugs, something like that. You can start to invest in some of these smaller managers, niches, nooks and crannies. That's where the alpha is.
How do you find them, the niches?
So we spend almost, I would say, 65% of our time, and including, I have 3 directors, pretty senior people, very simple investment team structure, director of publics, director of privates, director of operations. We spend most of our time looking for new ideas and traveling all over the world. We get a lot of great introductions from our existing managers, from other people with whom we partner with. We do a lot with other Midwestern institutions, so that I would say that the networking model amongst CIOs is very strong. We have put a number of people, as Mark suggests, in business by being the first institutional capital, and being the first check of size really obviously helps experienced people new funds. So people who have either managed before or are making the tough transition sometimes from analyst to PM, we have helped put them in business. And even though the business risk involved with investing in newer managers, and we have been wrong, we think that you can mitigate that business risk with a lot of upfront due diligence and also protections in the way you structure the relationship. But I agree with Mark, it is much more fun to deal with $2 billion in active management. And I have a slug of DFA. I love DFA. Shout out to University of Chicago. I use them as kind of a bookmarker wherever I go in the world where I want that beta exposure fast. And then if I'm able to find an active manager who really makes sense, I use that as a source of funds. So it's really talking to a lot of people, traveling a lot, and basically going wherever you think there might be a good idea. And we've tried some things that would be called either orthogonal or just pre-institutional, such as litigation finance, water rights. Because we are the University of Illinois, we're doing a ton with agriculture. People give us farms, we keep them. We want to have a very strong tie-in with the agricultural past and history that's ongoing with our institutions. So I think this is a very tough environment. Rebuilding a portfolio during the last 5 years when everything seemed pretty expensive has been a very challenging part of my career. And right now, especially, it does seem as though we're very long. The cycle is very long in the tooth. So I think this is a good time to be careful and more thoughtful than we always are. So super thoughtful, super careful.
What raises a question that I was going to ask here is, what is, I'll start with Ellen and then ask you, Mark, what is your risk profile like now compared to what it was the last couple of years?
Would you like to go first?
First, we really haven't changed it very much. We were actually at 0 treasury bonds, and we've added a few really for sort of, in sort of insurance in this kind of systemic crisis. But we're super underweight there. We are essentially the same spot with public market equities that we've been. So we haven't made any really substantial changes, and I don't anticipate that we will. It's really more kind of what you do, right? What you do inside of those classes. Again, so the fundamental change that we've made, as I was saying, is really looking more to process to generate the alpha as opposed to these sort of directional bets. I wouldn't mind actually, though, following up on the prior points, because we do things actually, I think, pretty uniquely and quite different, really different than the way Ellen was describing it at the foundation, at University of Illinois Foundation. We first we made this big kind of move into indexing. Now we still have some, of course, private market assets can't be indexed, and we wanted some access to public market. There are absolutely some great public market managers out there, and so the first we sort of did kind of two things. This became truly strategic for us. Number one, we ended what I call rubber stamp theater. So we ended this kind of totally dysfunctional process where a board spends 30 minutes with a manager and then makes a decision whether to hire or fire them. Totally, yeah, right. That just doesn't make any sense. Then you have a decision: are you going to have the staff make all the decisions, or are you going to get them some real resources? We decided to get them some big resources. So we actually outsource all of our the selection of our active managers. That's private market, public, and we call them strategic partners. We have 3, maybe moving to 4, and we pay them we absolutely pay them a few bucks. But look, it's actually far less expensive than trying to do it ourselves. And it's hard to find great managers that are going to really make money for you, right? And so we want to have just the best. So these strategic partners have large staff of folks who do exactly what Ellen was describing that her staff does, and kind of scours the globe and finds what we're looking for, which is the very best managers in each of the asset classes that we're going to have any active management in at all.
Ellen, let me ask you to sort of build on what you already said. You want to be cautious. So what works these days? What do you think is going to work, given the risk, all the things we've heard tonight, the risks and the opportunities?
So I think that we've all been waiting for interest rates to move up, like waiting for Godot. And I was starting to make my manager selection with this at the back of my mind as far back as the fall of 2013. So I wanted to have natural embedded hedges within the portfolio. So I went overweight certain financial strategies then, which had tremendous headwinds as long as rates stayed the same. But certainly as rates are now going up and there's a bit depending on the day of a slope to the yield curve, I do believe that having a lot of financials and a lot of value type investment strategies has to help, because we don't use leverage, and so this would be a bad time to lever up, hire a lot of managers or hedge funds with a lot of leverage. So maybe our average leverage is 1.6, 1.8 to 1. We have no top line leverage, nor will we ever. I'm willing to take concentration risk and new manager risk and oddball new idea risk, but I won't take financial risk, because I want to be able to give money to a manager at the bottom of the market when things are attractive. So the two things we've done is we have added to financials. We have, probably like Mark, we have, I met so many people who really were investing or getting ready for the next big credit cycle. I'm not sure when that will be, nor if there'll be one. So I have moved from hedge fund credit style strategies to a drawdown fund. I don't care about liquidity. I'd rather they only take the money when the opportunity is there and it saves us money on fees and the money is invested elsewhere. I have a big overweight in Japan. I'm looking to bump up my emerging market exposure in equities from 8 to 10. And I have a short duration global sovereign portfolio and global tips portfolio. So there's going to be some, there's inflation in certain parts of the world, and I believe that there'll eventually be some inflation here. So I really, this could go on for another 2 years, this good market. I want to be in the game, but at the margin, I'm tilting away from the S&P and investing in these other areas. I am fully invested. I might have around 3.7, 3.8% in cash. And I did just sell on the secondary market a legacy private equity portfolio because I think private equity is very, very frothy. But then again, I think everything's very frothy right now. So.
You agree with the froth idea? Obviously, we are not at the bottom of the market, Mark. So what works for you going forward?
So first off, going back to, I'm really not scared of public market equities at all. I mean, to me, I look at where forward PE is, and you've got a 3% 10-year Treasury. Even if that sucker goes up by another 100 bips, which I actually think would be a positive thing, and I think the economy would easily, and the markets would easily absorb another 100 basis points, right? Push up on I hope that happens actually that the Treasury gets pushed up with the Fed. You've got a forward PE of like 17. Can easily absorb that. So I'm not at all worried. And we recently actually put together, and we were revising our investment policy. We had a 100-page investment policy. So if you want to make sure no one ever reads it, have a 100-page investment policy. We now have a 4-page investment policy. You can go on our website and actually read it and understand what it is. And I was a peanut gallery, right? And I say, I want to put in there market timing is for losers. And then our general counsel sort of, they wrote it like a beautiful line that essentially says the same thing. Market timing just doesn't work, and it never works. So we don't want to go in that direction right now. What we do believe in, again, is process. And funny enough, on this opportunistic credit bucket, which we are very much overweight on, it's a pretty short-dated portfolio. I mean, this is stuff that turns fairly quickly. So if you think about it, and we think they're very, very intelligent managers that are highly conscious of the environment. These are not just asset gathering AUM, kind of mania type folks. So you have really short dated assets. Turn to cash quickly. Turn to cash. So you're looking at cash flow, right, to create the liquidity as opposed to asset liquidity. Good luck with asset liquidity, right? So something that we're quite negative on is, which I mentioned to you earlier, is something like high yield bonds or emerging market bonds, where you sort of right you're getting these super low yields, and in the case of emerging market, you got horrible event risk. In the case of high yield bonds, okay, sit behind more leverage than the typical S&P 500 stock, right? But you don't have that pesky upside, right, that you get with equity. So right, so I don't know why you sort of do any of that. So that's kind of how we're sort of viewing the world.
I'm curious, Ellen, before we go here, you mentioned that you have reasonable exposure to things that go bump in the night. What goes bump right now that you find interesting?
So when I say that, I don't like to use the term global macro risk hedges, but so I have a 63% in global equities, and that can range up to 80%, and that includes about 10 to 12% in private equity. So, and that's a highly concentrated part of the portfolio. Most of our managers, I would say, on the long only side, tend to have between 15 and 20 stocks, and maybe 25 to 35 if they're shorting. We don't use the category for hedge funds or even alternatives because we have a ton of them, and we place them where they belong based on the underlying asset. And we've constructed a portfolio that blows up these notions of, I have hedge funds that don't hedge. I have hedge funds that are 100% long. So we just said, let's stop calling them hedge funds because many of them are highly directional and do not hedge. So I have hedge funds all throughout the portfolio. And then this troubling part, which has been hard to to fund is like global credit, global diversifying strategies. So we have odd stuff in there. We have some RMBS derivative strategies. We have litigation finance. We have some cross-capital structure managers that might have a little merger arm, a little event-driven stuff. These are all managers that I'm pretty sure that most people haven't heard of. And we hope that they will do well. We want to be good partners with them. But so that will all go down at the same time. So I have educated my investment committee that meets next Monday morning to understand that when the proverbial hits the fan, this will all go down at once, but the 17% will go down less. So the 20% is the part of the portfolio that will not behave like the other 80%. And in that, we have global sovereigns, global inflation-linked bonds. We have opportunistic, non-core real estate. We have agriculture, which is not correlated to anything. We have some land strategies, and we have both public and private energy, and we have added within the last year to publicly traded natural resource equities, because let's face it, it's been the least loved part of the market, and that got our attention. So it's hard to find things that are not overcapitalized, and natural resource equities was the one thing within this last year that really was not getting any inflows of money. In fact, most people saw an article today in the paper, most people have left the business. So we will see. Now, obviously, there can be volatility in those sub-asset classes, but we believe that they will behave very differently than the other 80% of the portfolio.
All right, 10-second question to each of you to wrap this up. What over the next 12 months do you think, just pick a number, is going to be considered a good return?
You're just talking about, are you talking about domestic equities or a full
your overall portfolio return?
Look, if our target return is 7%, as long as we hit 7%, we're pretty happy. I'm a little more bullish than that. I think we're going to do a little bit better because of some of these nooks and crannies where we're investing. I think we can pick up material amounts of alpha. And I'm okay with the stock market. I see it sort of getting past these, interest rate increases and,
So last year we had a fantastic year of 16.9, 17% for the fiscal year, which I believe was the third best return of all endowments in the country. This year, going into 630, looking at 8.25. I got a guy with a lot of Italian banks that just blew up on us 2 weeks ago. So and on Monday morning, we do our annual asset allocation 10-year forecast. There is no doubt that the expected returns, by definition, have to be lower because the markets keep going up. So my beta return for the portfolio is 5.4, and then the all-in with alpha that I believe we can generate through active management, it's 7.4. So not that different from yours.
They're pretty similar. Thank you both very much, Ellen and Mark.
Thank you, Michael.
Thank you. Thank you very much. Well, that does it for us. Concludes our program here. Hope you all learned something and have something now to think about going forward. We'd like to thank our sponsor, Invesco QQQ. There are two ways we can continue this conversation now. You can, of course, as we mentioned at the top, go to Twitter. The hashtag is hashtag the future of. The handles are at Bloomberg Live and at Invesco US. The other way we can continue the conversation is join us in the gallery room for additional food and drink. Thank you all very much for coming. Great to have you out tonight.